Hello, ladies and gentlemen. Welcome to the show. Listen, I'm glad to have you guys here on this nice Sunday. Well, the sun's out today. We got a lot of snow in the yard. It was a bad storm. You know, the wind blew for like 3 or 4 days. You know, I want to talk about my track record here. What I do on this channel is financial trends forecasting. And you know, the financial system, it's sort of like a body of water, say an ocean, you know. The water is always in movement. And when you go to the ocean, you don't know what to expect to actually see. Whether you're going to see big waves or you might see a calm ocean, and the water is constantly moving. That's like liquidity in the financial system, constantly moving around. And there's so many sources of liquidity, and they've generated so many new sources of liquidity where they've taken and they've built financial products on top of layers of derivatives that are built on top of layers of an actual asset that underlies it all. They built layer upon layer upon layer by over leveraging the system, probably in the order of 100 to 1 of what the real assets are out there. So the system actually wants to deflate. It wants to deflate terribly bad, but the world central banks are keeping the system from deflating. Now, in predicting all of this, it's all dependent on what the central bank decides to do. Depends on actually what happens in the system. Like I say, the system wants to deflate. But if the system starts to deflate and the central banks come in with even more stimulus, they're going to continue to blow up these bubbles, these financial bubbles, larger and larger and larger. Deflation is fast, inflation is slow. Never forget what this Fed has got their mandate of a 2% inflation rate. This means that they want to err on the side of inflation. This means that they won't allow deflation. This is why Ben Bernanke said, if we have any deflation rear its ugly head within the system, we will actually drop money from helicopters if we have to. They're already telling you what they're going to do. Now, in 2008, what happened is the system started to burst and we started to get deflation. They smashed it with tremendous stimulus. Never underestimate what the Fed can do. But on the other side of this coin, in the very unlikely prospect that the Fed were to pull back and decide not to do anything, well, we've got a market right now. Markets, not just one market, but markets all around the world. The NASDAQ, the S&P 500, the Dow Jones are all over-leveraged. They are in such a hyper bubble right now, it's unbelievable. The amount of pressure. That is pressure that's driven those markets up. It's stock buybacks, it's tax rebates, it's everything. Just constant pressure that's built to get the markets up to this point where the markets are right now, over-leveraged. It's a hyper bubble. It wants to pop, but the Fed's not letting it pop right now. They're driving tremendous stimulus into the market, so the market's going to go higher. It's going to go higher, but as it goes higher, it's going to exert even more pressure on the market to fall. So the higher it goes, the more pressure it's there for it to fall. What it reminds me of if a man were to go to a dollar store and buy the cheapest Chinese-made dollar store garden hose he could find. And if he took that garden hose home and hooked it up to his 1,500 PSI, pounds per square inch pressure washer, and turned his pressure washer on. This is what the markets are like. This is the pressure that is under the markets. What could go wrong? What could go wrong? Just add more pressure. Of course, the more pressure you add, the more likely you're going to get a failure in the markets. We've got to the point where any situation, any black swan that comes along, out of nowhere, something we don't see, could cause a sudden deflationary shock. And this deflationary shock could happen in a matter of hours, before the Fed could even hardly respond to it. They'd have to get out of bed to respond to it, you know. So, you know, what I do here, getting back to what I do here with financial trends forecasting. I've got a very good track record. I would say my track record, I haven't been wrong very many times over the last 4 or 5 years. You know, if you guys been watching my channel, like going back maybe a few years ago, I was telling people, hey, you know what? Take a second look at Litecoin. They're only $3 a piece, or $3 and change a piece. You know, take a second look at them, I was telling people on my channel. A lot of people thanked me for that advice. When Litecoin went all the way up to like 300 bucks, you know, they've dropped back. They're like $47 today, you know. But I still look at them as an excellent value. Silver, oh my gosh, nothing in the world. You're looking for a value class right now. Now, I'm not giving financial advice. You guys we're just talking here. If you look at the fundamentals of silver, how much it costs to get it out of the ground, how the world's financial system is being overinflated, how silver and gold are safety asset classes in deflation and in inflation. If you take a look at the overall picture, people are scared right now. Where do you put your money? Money's running around the system. They're thinking, oh, I'm going to buy some bonds with my money, or I'm going to buy into the equities, you know, or money market funds or whatever. They just don't know where to go with it. For some reason, they don't take a second look. The big money doesn't take a second look at silver. Such a small, tight little market. It is being overlooked. More so than gold. Gold's great. I like gold. I think it's good stuff, you know. But silver has the potential to make even higher gains than gold. And you know, gold's going to go up to 5,000 bucks soon. In my opinion. That's just my opinion, but I think in the next couple years you're going to see gold really skyrocket in price, because I really don't think the central banks are going to go down that route. Let the deflation just spiral out of control. Because what it would lead to situations that they are not prepared to handle. Quite seriously, that's what it would lead to. It would lead to world situations that would be frightening, to say the least. Because what would happen is basically it would spiral out of control if they let it go too long. Deflation. The whole system would completely deleverage itself. And the system is so over-leveraged. I mean, in the past, sometimes, that's the job of a recession, is to deleverage the system. Well, they didn't deleverage after 2008. They didn't let the system deleverage. They over-leveraged it up even higher. And now they're leveraging even higher again. It's unreal, the amount of debt that's become credit. I mean, it's a strange world we live in. But now, I mean, if you take a look at the system, we've already had our warning. And people are starting to get complacent again. The market has such a ability to forget what happened just yesterday and move on so quick. They forget that we had a yield curve inversion already, which precedes a recession by a few months or maybe a year. We've had it already. It's in the past. Now we're heading toward that recession. The world's starting to slow down amazingly fast. They talk about black swans. They say, well, a black swan could come along and take down the financial system. Very correct. And I think your black swan might be the data numbers that's going to come out of China and the Chinese banking system and the Chinese shadow banking system. I think that's coming early next year. And I think it's going to be news that is going to impact the financial system extremely adversely. At the same time, you got an over-leveraged market. Now, what about the election cycle? They say, well, okay, we'll probably make it through the election cycle before we have this recession. You know, that's a long ways off. And we got a system. That means that the Fed will have to keep over-leveraging and keep overextending this stock market all the way up until almost the end of next year, or the end of next year. That's a long time. That's like what, 14 months they're going to have to carry this thing through the entire election cycle. It's like 14 months with a stock market they're going to have to keep it going higher and higher and higher and higher for the next 14 months with the pressure it's already got on it. I'm not going to say it's impossible. But in my mind, it just seems unlikely that they could carry it that far. I think a more likely possibility to happen is sometime in maybe the first quarter or possibly the second quarter of next year, we're going to get a sudden bad news from someplace that's going to trigger it. A sudden drop-off in these markets that's uncontrollable, because these markets now are controlled by computer algorithms. They're controlled by trading bots. And I think we're going to get a steep fall-off that's going to scare everybody, and I think it's going to scare the Fed. I think what's more likely that's going to happen is that steep fall-off is going to be stopped by the central banks. Might happen while they're sleeping. They might wake up, and the futures are way down and the market opens up 2,000 points lower. And they wake up the next day and they are all scrambling to the office, the people that work at the Fed, trying to arrange some sort of a plan to prop that market back up again. And it might only be a sort of a thing that lasts for 48 hours before they do whatever they need to do to get the market to stop falling. Whatever they do at that point in time is going to tell everyone in the world out there that the Fed has actually lost control over the system. And what's it going to lead to is it's going to lead the market's going to start going back up again. In fact, it might climb back up higher than when it fell. It might look almost like a flash crash, but it's going to trigger that action by the central banks. I think this is a more likely scenario of what's coming next year. And that's going to lead us directly in to the lead-in period to hyperinflation. Not a hyperinflation, but what's called a lead-in period, which is called the acceleration phase. That can last quite a while, the acceleration phase. But what you're going to see in that acceleration phase is price increases that you haven't seen before. And that is going to be the starting, when you just start a race, bang, and they all run. That's going to be the starting of the gold and silver and cryptocurrencies really making their way up. Because that's going to be like the warning shot that the Feds cannot ever stop pushing money into the system. So, see, there's only two directions this can really go. It can go deflation. I mean, if the Fed decided to just basically stop pushing money into the system would completely deflate. I don't want to tell you what the system would look like if that happened. The whole system. Even the just-in-time supply deliveries, the companies, like trucking companies and stuff, they would go under if everything deflated, because they're connected into the banks. The banks would go under. Everything would just basically grind to a halt if it all deflated now at this point, because they've over-leveraged it so bad. And it would be a horrendous situation. Now, in the opposite direction of that, the direction where they're most likely to go, because it's the easiest way for politicians and leaders and even the people at the Fed, the easiest way to go is just to keep inflating it. If it requires more, add more. More stimulus, add more stimulus. This is the direction they're most likely to go in because it's the easiest direction. It's the direction that'll preserve their jobs. Because if they let it deflate, they're basically out of work. Everyone's out of work. And they're going to have a whole bunch of angry, very, very angry people. And they know that. I mean, they didn't get in the positions that they're in by being stupid. So, they're going to keep inflating it. And ultimately, what's going to pay the price for that keeping inflating it is the fiat currencies. And this is going to drive alternates to fiat currencies. Well, there's not very many alternates, really. that don't have any counterparty risk, because when the system starts to become really unstable, people are going to start to worry about counterparty risk. It's going to become a problem. And there's not very many dollar alternatives that don't have counterparty risk. I can only think of 3. Really. Gold, silver, and cryptocurrencies. I can't think. Can you guys think of something else? Maybe if you had a storage facility, maybe you could store real oil. That would always be worth something, you know. But then again, petroleum products, if you let them sit too long, I suppose they can go bad, you know. There's not really much else that you can actually have that has no counterparty risk. Maybe you could buy an antique car or a fine art or nice painting or something, but still, very few things. Listen, you got to prepare for what's coming. They've created a situation where they've created basically the whole world's financial system is created on a foundation of a Ponzi scheme. And it was fine back in the day when the world was growing and the financial system was growing. But like all Ponzi schemes, they're like a shark. A shark has to constantly swim, or the water doesn't go past his fins and he doesn't get any air. He actually dies of asphyxiation if a shark doesn't swim. The financial system's the same way. It has to keep growing that financial base. It has to keep borrowing money into existence. If it goes in the opposite direction, it can't. It implodes on itself. And this is the kind of system that they've created. So there's only one way out, and that's modern monetary theory, which basically is print, print, print. This is the only direction that they can move now. And so where it ends in a debasement of the currency to the point where your bank account's it's not even worth. You might have $100,000 in the bank, and imagine that the gasoline in your car costs more than it's worth to drive in and take your money out. That's if you can still even take your money out, because they're going to try to convert the whole thing over to digital. And how do you extract it from the bank then? You have to spend it. This is what they want. They want you to spend money. Think counterparty risk. Everything that you own has counterparty risk. Even your land. Even if you own your land outright and you have the deed, the taxes on that land every year is counterparty risk. Because what happens is if you can't pay those taxes, if you haven't got the money to pay those taxes, it goes back. They'll sell your property. So you don't even own that. That's counterparty risk. Your bank account, tremendous counterparty risk. They're just like sharks after your bank account. They could come right in the bank and just shut the doors and say, okay, that's it. You guys are only allowed so much a day. And then they won't fill the machine. So they call that, they're already doing that in some countries. I heard about a country yesterday. I can't remember what country it was. Where they're only allowed so much to take so much out of the bank right now. And they're all lined, I think it's Lebanon or someplace. I can't remember which country it is, but they can't get in to get their money. They can't pay for their apartments and stuff. The landlords are kicking them out and stuff. The banks have just froze their money, and they're desperate for bank runs, It's already starting in some places. Because there's counterparty risk attached to your bank account. The bank basically owns that money, not you. A lot of people don't know this. A lot of people watch my show and they say, oh my goodness, I didn't know that. I thought that money was mine. No, it's not yours. It belongs to the bank as soon as you give it to the bank. The only thing that's yours in this life is basically your own skin. But if you're holding a piece of gold in your hand, it's yours. No counterparties. There's no counterparties, and so there's no risk associated with it. It's yours. It's in your hand. It's very difficult to get anything in this life, to come away with anything in this life that has no counterparty risk, that somebody can't come and take from you. Thank you guys for listening. I really appreciate my audience out there. You know, I appreciate having a format that enables me to reach an audience and inform them in these hard economic times that we're moving into. Thank you guys, and we'll catch you guys in the very next show. Probably a market report. Give me a thumbs up, and we'll catch you later. Bye-bye, guys.